Hello, everyone. My name is John Jentz. I'm the CEO of Latitude Uranium, and happy to be here to talk about our recent assay results. Our last batch came on December 4th. The first batch came on November 7th, and so all 18 holes are out now. And I think there's three big takeaways from our drill program this year. One is that we've extended known mineralization. We've grown the resource, and again, next year we'll be updating the resource so people can see what that means in terms of numbers. But we'll look through some of the cross sections and see, you can visually see how that's happening. Two is we found a new lens, which we believe our working geological theory is this is the hanging wall mineralization, which, if true, makes the future to find more of that type of mineralization across the deposit a great thing for next year and the future. And secondly, we're understanding the geology a little better in terms of we have what's called these cross-cutting structures coming through. And we, when you look at our press release on page 1, you can see that sort of coming. You can see the main zone going across the page. You can see these cross-cutting structures coming in. And what it means geologically is basically they're splitting the rock as they come through. And in those splits, that's where the fluids can go. And that tends to be where you find the mineralization. That tends to be where you find the higher grade mineralization. And so, our hole 5. That's if you look at the very bottom of the page where it says off-scale radioactivity, 7.5% over 1.6 meters. You can see that sort of at the edge of one of these cross-cutting faults. And again, when you look at the new lens, it tends to be on the edges of these cross-cutting faults. And although it's a picture, it's not quite that simplistic in the real world, so it's not quite that easy. But our vectoring and our targeting are getting more refined and more sophisticated over time, which is a good result of this year, which will augur well for us for next year. And so really the three big takeaways are we're growing the mineralization, we found a new lens in the hanging wall, and if this hanging wall theory holds together, which we'll be testing next year, we should be able to extend the hanging wall across the better part of the deposit, which will add mineralization as well. In this hanging wall, in an eventual mining scenario, you're theoretically turning what it would otherwise be in an open pit scenario, waste, you're turning it into ore, even though it's a little lower grade than our average grade. Anything that's ore is not waste, just increases or decreases your strip, increases your economics in an open pit scenario. So it's all very positive. We're very happy with the results. And as well, we just closed a $6 million deal for flow through. So currently we have about $11.7 million. We're fully funded for next year. And so we're excited to go away for the winter. We probably should open up back in late May, probably, depending on the weather, and get out our 2024 program. We don't have it fully spelled out, but we've got some concepts we need to work on. Obviously, we need to get board approval and make sure that we're all aligned in terms of what we're doing. But that's the conceptual plan for next year. And don't forget, on the CMB, we're still waiting today for two things. One is geophysics from Mustang Lake. Hopefully, it's going to show some targets. And the property-wide AGG, it's called Airborne Gravity Gradiometric Survey, which is a mouthful. But what it's going to show is additional uranium that we don't already know about, and the potential for IOCG, or iron oxide copper gold, if it is there. Depending on the results of those two surveys will dictate what we do and don't do next year at the CMB, but that's coming. One will be out sort of at the end of this month, and maybe a little bit into the new year. So a little bit more news flow coming, and that'll dictate what does or doesn't go on in the CNB for next year.
Okay, John, I appreciate you kind of running through that kind of pitch, as it were, as to how things are going and obviously where things are going. Can you just a couple of questions though before you go, which is around congrats on the $6 million raise, closing that. That's fantastic. You're funded for next year. All good news. Are you saying at the moment the kind of plan for targeting, modeling the drill bit for next year, the drill plan for next year, is not quite there? I mean, what else have you got to look at to kind of work that out? What's the timing?
Well, we've got a list of about 25 targets, and it's really just prioritizing where we think we're going to get the greatest bang for the buck. And so, it's as we learn more stuff in the field, as we update the models, as we develop sort of these cross-cutting structure theories, we continuously refine and update these targets. And so we have an idea today, but because the team has been so busy on a number of fronts, January is probably the time where we really go into a deep dive. We'll all get together in a room and we'll go over sort of what we all think the priorities are, and we'll just rank them. And you have to be a little bit flexible too, because you have to have some extras in your back pocket, because when you get up there, given things are melting, don't forget we're tugging the drill around on basically if it's so in the winter we can tug it around on the ice, but you have to find some pads where it's not mushy to put it down, or else it just sinks. So we might think our number one target is in location A, but location A may not be accessible for 3 weeks because it won't be dry for 3 weeks. So we need to be a little bit flexible, but we've got a plethora of targets, so that's not the issue. The issue is ranking them. And again, we have a list today, but we'll be refining that list over January and be ready to roll in late April, early May.
Okay, and okay, appreciate that. So you got to be flexible. You don't know what the nature is going to throw at you. I get it. With regards to what's going on in the market, though, we're seeing I think we've talked a little bit about it in the past, which is the strategy for creating value. You've got money to drill, and those drill results based on your latest press releases are throwing up some high grade 2.88 over half a meter to just over 2 meter, 2.5% over half a meter. The high grade stuff's there. What do you think you need to be targeting? You got to find more of these lenses, and you talked about the hanging wall potential. There is what's going to make a difference for you adding pounds or significant pounds to this thing. Aiming for that 100 million that we've talked about in the past. I mean, have you got some? You must have some thoughts now about how you get after that, or is that data still yet to be analyzed?
The data's still there. Our plan's always been it's been the same plan we've always said is drill this year. I think we've done a fairly good job, and the results are fairly decent. We're going to do the same thing next year. The size of the program obviously to be determined, but you can tell by the money in the bank, the rough size, and update the resource at the end of next year. And if we can demonstrate to people some decent growth, and again, if the market rewards us for us, which I'm hopeful it will, we can get the story out. Obviously, our valuation should be much higher. That's fine. We'll continue along towards that £100 million mark. And if it doesn't, then we have to consider what our alternatives are, which is, potentially things like we'd have to demonstrate the potential of the deposit in a form of some type of economic study, a PEA or other. To show people that if they're not wowed by the growth in the resource from 43 to whatever number we're going to get to, they have to be wowed by something else, because it's a very good deposit. It sort of fits a very good niche in the world of uranium. Between on the left hand side is sort of very early grassroots and production. It's sort of sitting there right in the middle, ready to sort of go into some form of development. Again, if it was a smaller company, we might head down the development pathway very soon. For the larger companies, everybody wants that magic 100 million pounds. And when you work through the math, the reason that is because, at the average grade, it would be sort of a 5 million plus pound per year asset, which, go to the WNA website, it would put it in the top, if not 5, top 10 in the world. And it's right there. So it's tangible. It's there. We just have to figure out what, maybe it's me, maybe the market's not, maybe the market doesn't like me. I don't know, but the asset's fairly good. And so either we're not telling the story properly, but we need to get that out to people. And if they don't like the resource growth, we're going to have to figure out what that means in terms of modifying and adding to our strategy.
Okay. Well, I think a few uranium stories are starting to take credit for the movement of price out there, in terms of the spot price out there. What do you think the reality is in terms of where that value lies? Will it be a case of just delivering those pounds, or will spot getting through $100 just do it for everyone?
Hard to say. I think, because when the spot price moves, you have to also take into consideration with the spot prices what the contract price is, which is the more longer term view. If you're actually going to develop a mine, if you're just trading in and out, obviously the spot price is more important. But if you're looking at a development scenario over time with a mine, and you're looking at a sort of a 5 to 15 year time horizon, you have to sort of look at what where the longer term price is, and even if spot jumps to 100 for whatever reason, it all depends on sort of the cumulative wisdom of the market of where they believe the long term price is going to stick. And so I think the issue with some of the assets out there are that the technical studies are a little old. Maybe the prices are not representative of that, and I still don't think people, even though the spot's 80 plus now, I don't think people are quite there in terms of, is 75 the new long-term number? Maybe for some people, maybe. Is it 60? It's a different number for different people, and then everyone has a different if you're a utility using it, you want the lows. Buyer wants high, seller wants low, all that. But I think it just takes a little bit of time for the spot to go wherever it's going to go, and the long term to sort of moderate to wherever it's going to go in terms of a consensus. Those the development assets out there will have to have a there's conventional wisdom in the market that people need between $70 and $80 to bring some of this marginal production online, or the incremental production. Is that true? I don't know. We'll have to see.
Well, we'll have to see. But I tell you what doesn't seem to be working is the fact that some of the producers, obviously Cameco's cracking on it, and others like them. But the developers, $80 doesn't seem to be working for anyone at the moment. Do they need to see 3 months or 6 months sustained, higher lows? I mean, how do these guys get funded? How do they say to the market, this is a reasonable time to give us the money to actually go out and build our stuff?
You have to. I think it has to be from the investor base. They have to agree that whatever the technical study says in terms of what it needs in terms of a long-term price to make a base, that the investors agree with that. And I think the investors are still, it's a reasonably small universe. I wouldn't say they're skittish, but they're, as things move up, people are skeptical that it's going to hold. But as time moves on and it's sort of self-reinforcing, there's some point in there where things move up. And, I wouldn't be terribly surprised. I think the problem is most investors just expect, like, for example, in copper and gold, as the price moves up, incremental production comes online. I wouldn't say instantaneously, but, existing producing mines can bring on marginal cost of production as the price moves. In uranium, it's not as easy as that, because it's more regulated, and it's the production of the Athabasca is what it is, and it's high grade. It's really a technical question, not a financial question. And so the industry is just not big enough to be able to accommodate that, and so it needs new production and new mines. And again, juxtapose the development timelines against maybe copper or gold, and they're longer, they're more regulated. It just takes time, and so that there's a lag effect. And I wouldn't be surprised if you see, either utilities or maybe upgraders somehow securing supply at more at the mine site, and doing what some of the streamers and the other people do in copper and gold, which is give in exchange for guaranteeing 90% of your yellow cake, we'll loan you X hundred millions of dollars. Obviously, you have to repay it, but that's sort of the quid pro quo that we've seen in other industries. And it wouldn't surprise me if that sort of happens again, because if the investors don't catch up enough, the utilities will have to do it, because they're unfortunately having to buy this in the real world and supply the reactors in the real world. And so, again, it wouldn't surprise me to see them dip their toe in, either as a principal or as an agent, or contract somebody in the middle, one of the upgraders, to do it.
It's a really interesting point you make there with regards to, obviously, I think 20 years ago, royalty and streaming seemed like a novel idea. Uranium's had obviously a recent checkered past, but now it seems the infrastructure, the governments, the regulations seem to be very pro-nuclear as part of a solution. Do you think that it is possible, as you say, to have this new form of financing for the uranium space? Maybe it's a rehash of what else is going on elsewhere, but for uranium, that's quite the leap.
It is, but I think people are coming to the realization that really, if you want to borrow an acronym from the old world of low interest rates, TINA, there is no alternative. I mean, look, you don't have to be a uranium bull, but look around the world. Unless you want to start rationing power, how are you going to even, uranium has to keep up with the GDP per capita growth rate, and the world's growing. There's more people in the world. We all know that, and more people use more electricity. And nuclear or green power has to get not only its GDP per capita growth, it has to take away from the fossil fuels, the oils, the natural gases, and the coals. If we're going to have any hope of getting anywhere close to any of these net zero targets of 2030, 2050, they keep moving around depending on who you are and what you are. But really, again, if hydro and wind just aren't quite there in terms of reliability, supplying baseload power, battery technology. It's all developing, but not there. And if you don't have hydro, because you don't have a river, well, you're Tina. There is no alternative. All roads lead to hydro. So, it doesn't mean it's going to go crazy, but I think people are coming to the realization that if you need constant baseload power and you throw into the mix the geopolitical tensions and you need, power security, if you will, or energy security, that's one thing that you can act on today. You can't act on others today. So I think, to me, that tells me that over the next 5 to 10 years, it's going to be a secular bull market. How fast, how quickly, people always think it tends to move a little quicker than it should, but but it's not driven by me or anyone else. Look around the world. I mean, look at, there's an increasing adoption of climate change, the recognition of climate change. Summers are getting hotter, winters are getting colder. There's more fires, there's more natural destruction all over the world. The reinsurance market is going crazy, trying to deal with all this. And so there has to be nuclear power, more than its pro rata. It's a small portion of the world's power. It's only 10%. So, it's got lots of room to go. But again, it's, the mining of it is not the most difficult part, but it's a regulated industry, the regulated channels, and, it just can't move on a needle like, for example, copper and gold can.
Well, look, you made some good points there. John, I'm looking forward to seeing what you do with your $6 million, and I look forward to you coming back on and telling us all about it. Appreciate that. I think, there's a lot of kind of cash constrained companies out there, envious of what you're going to be able to do. Stay in touch. Let us know how you get on, okay?
Terrific. Thanks, Matt.